Is Joby Aviation currently in a death spiral tailspin flashing massive sell signals? Or is this an incredibly undervalued buy the dip opportunity for the bold?
Oh, man. I mean, that is literally the ultimate billion-dollar question hovering over the market today.
It already is.
The divide on this stock between analysts, retail traders, and the big institutional whales it's completely staggering.
Because if you look at the landscape today, and just to set the stage for you listening, today is Thursday, April 23, 2026.
Right.
Joby stock, ticker symbol JOBY, just closed down 7.11% at exactly $8.49.
Yeah, that is a heavy drop, especially on a day when the broader indices just weren't seeing anywhere near that level of punishment.
Exactly.
It's a massive recalibration. It tells us that investors are, heavily reevaluating the timeline of when, or honestly even if, this company shifts from a futuristic cash-burning research project into a functional transit network.
And that's exactly why we are doing this deep dive today. We're pulling together a massive stack of sources for you.
Oh yeah, a ton of data.
We've got the latest financials, the technical order flow, insider trading data, and analyst reports.
To figure out what is actually going on under the hood before their Q1 earnings report drops on May 5th.
Right, because we have to look past the shiny concept of, flying cars and look at the brutal math of the stock market.
Yeah.
But hey, before we jump in, remember, this is an educational deep dive, completely natural human debate, and absolutely no financial advice.
None at all. Do your own research.
And if you want more of these deep dives, make sure to like the video, subscribe to our YouTube channel, and it is compulsory that you leave your feedback in the comments below.
We want to hear from you.
We really do.
Yeah.
So look, before we can debate if this company is going to change the world, we have to address the immediate bleeding on the charts.
The charts are definitely flashing some serious warning signs. Let's frame that $8.49 closing price.
Okay.
If you zoom out to the 52-week context, Joby hit a high of $20.95 back in August of 2025. Right. And today, we're drifting dangerously close to the 52-week low of $6.03, which they hit almost exactly a year ago in April 2025.
So they've given up almost all those gains, and the market cap is sitting around $8.32 billion right now?
Yeah, roughly $8.32 billion. But the trend direction is undeniably bearish. I mean, the price is trading well below the 50-day moving average, which is up at $9.32.
Right.
Way below the 200-day moving average, which is sitting up at $12.75.
Okay, let's unpack those technicals for a second, because I know a lot of people tracking this stock look at the relative strength index, the RSI.
Oh, absolutely.
Right now, the RSI is at 35.2. And for anyone unfamiliar, an RSI nearing 30 generally signals a stock is entering oversold territory.
Yeah, it starts flashing green for some people.
Exactly. So for a lot of retail traders, that 35.2 looks like an absolute screaming buy signal, like a discount bin.
Right.
It looks like the panic has exhausted itself. But then you pair that with the main CD, which is sitting at negative 0.158 and flashing a bearish downward crossover.
That's the kicker.
So isn't trying to buy this just like trying to catch a falling knife?
Yes. You're touching on a classic trap that catches a lot of inexperienced traders, actually.
How so?
Well, think of the RSI like a stretched rubber band. Yes, at 35.2, it stretched pretty far to the downside, suggesting it might snap back.
Okay.
But the MACD acts more like a momentum speedometer. A downward crossover means the short-term selling momentum is currently accelerating faster than the long-term trend.
Oh, I see.
So the rubber band is stretched, but the force pulling it down is actually getting stronger, not weaker.
So buying now assumes the rubber band won't just snap entirely.
Exactly. And when you look at the order flow, we saw heavy selling pressure today, but with a drop in volume.
Which means what exactly?
It's a toxic combination. It doesn't necessarily mean a massive army of short sellers is attacking the stock. It means the buyers have simply stepped aside.
Oh, wow. They're just letting gravity do the work.
Precisely. And the support levels below $8.49 are incredibly thin. There's a tiny shelf of immediate support at $8.31 and another at $8.09. But realistically, if the selling continues, there isn't much of a structural floor until we hit the $8 psychological mark.
And if it breaks $8, we could be looking at a rapid slide back toward that $6.03 low.
Easily.
But look, technicals only show us what the price is doing. To understand why the buyers have stepped aside, we have to open up the financials.
Well, the fundamentals.
Because the moment you look at the balance sheet and the income statement, you realize this company is essentially a billion-dollar furnace.
That is the perfect way to describe it. The scale of the cash burn it's just difficult to overstate.
Let's run the numbers for you listening.
No.
Looking at their full year 2025 income statement, total revenue was only $53.4 million.
And keep in mind, that revenue isn't from selling futuristic flying taxis.
Right. The sources specifically note it's largely from their blade operations.
Yeah, the traditional helicopter service they acquired.
Exactly. Just to start building out their operational footprint and infrastructure. But against that $53 million in revenue, their net loss was a staggering negative $928.5 million.
It's just a massive number.
The operating loss alone was negative $719.6 million. They're burning through over $700 million annually.
Yeah.
Why is it so astronomically expensive for them to just exist right now?
Well, because they aren't just building an aircraft, they are inventing an entirely new segment of commercial aviation from scratch.
Right.
That $700 million isn't just going into a cool prototype. It goes into funding massive manufacturing facilities in California and Ohio.
Oh, sure.
It pays for fleets of aerospace engineers, intense lobbying efforts, and exhaustive flight testing. You have to remember, prototyping is relatively cheap.
Designing the assembly line is what gets you.
Exactly. Designing an assembly line that can mass-produce aerospace-grade carbon composite aircraft while navigating completely unprecedented federal safety standards is violently expensive.
Violently expensive. I love that. And that aggressive cash burn brings us to their lifeline. Because they do have cash. A lot of it, actually.
They do.
Following a capital raise they executed in February 2026, they boast an estimated $2.6 billion pro forma cash runway.
Which is huge.
And for anyone wondering, pro forma just means this is what their balance sheet looks like after factoring in that recent massive influx of cash.
Right.
Plus, they have virtually zero debt. Their debt-to-equity ratio is practically non-existent at 3.14%. So on paper, it's like they have the biggest gas tank in the world.
What's fascinating here is it creates this incredible illusion of safety.
How so?
Having $2.6 billion with no debt sounds bulletproof to a lot of investors. But if we connect this to the bigger picture, banks do not lend billions of dollars to pre-revenue, unproven aerospace startups.
So they can't get standard loans.
Right. Joby can't rely on debt. They have to rely on equity. And when your engine is burning almost $1 billion a year, that massive $2.6 billion gas tank, it only buys you roughly 2 to 3 years of runway at their current burn rate.
Wow. So they're essentially just sitting on the tarmac, burning fuel, waiting for clearance from air traffic control.
Precisely.
Which makes me wonder, if the math looks this grim, how are the people who actually see the books reacting behind closed doors?
That's where we look at the order flow of who's actually buying and selling.
Right, because there is a stark divide between the insiders, the institutions, and the retail traders right now.
Let's start with the insiders, because that data usually sparks the most emotional reactions online.
Oh, for sure.
Over the last 90 days leading into April 2026, we've seen 7 distinct insider transactions resulting in $2.24 million in net sales.
Okay.
And that includes planned sales by the CEO himself.
Okay, here's where it gets really interesting, and I actually want to push back on this a little.
Go for it.
When retail traders see a headline that says, CEO sells shares, the immediate reaction is panic.
Right, the captain is abandoning the ship.
Exactly. But realistically, for a company with an $8 billion market cap, is $2.24 million really a red flag?
No, it's not.
Right. Aren't these executives heavily compensated in stock? Meaning they have to sell shares just to pay their taxes or diversify. We're talking about 10b5-1 plans here, right?
Yes, that is a crucial distinction to make for anyone listening. The vast majority of these insider sales are executed under what the SEC calls a 10b5-1 plan.
Which is automated, right?
Exactly. It's a pre-scheduled, automated trading plan set up months in advance. It prevents executives from being accused of insider trading because the sale happens automatically on a specific date, regardless of the stock price. So no, $2.24 million in scheduled sales by executives is absolutely not a reason to hit the alarm bell. It's a total red herring.
Okay, so if the insider selling isn't the problem, why is the smart money, the institutional investors acting so cautious, while retail interest remains super high?
Because the institutions are looking directly at the silent killer of portfolios, severe dilution risk.
Oh, the equity raises.
Right. We mentioned that Joby survives on equity, not debt. When they need cash, they issue new shares.
Right.
Since 2021, Joby's outstanding share count has ballooned from 604 million shares up to 979 million shares.
Wait, really? Almost $1 billion.
They're rapidly approaching 1 billion outstanding shares.
Explain how that mechanic actually traps a retail trader. Because from the outside looking in, a retail trader just sees the stock price drop from $20 to $8 and thinks, wow, the company's on sale.
Yeah, they see a 60% discount.
Exactly. So why is that a trap?
It's the difference between price and value. Imagine a company's total future value as a sprawling 100-acre estate, okay?
Okay.
When there were 600 million shares, buying one share got you a specific, measurable plot of that land. But to raise that $2.6 billion we talked about, the company didn't borrow money, they just printed millions of new shares.
They subdivided the estate.
Exactly. So today, at $8.49, the price of a single share is cheaper, but that share represents a drastically smaller piece of the total land. The company isn't fundamentally cheaper. Your slice of the pizza just keeps getting smaller as the share count expands. You're buying less ownership for your dollar.
And because they are burning nearly $1 billion a year, the sources indicate they will inevitably need to print more shares.
Oh, undoubtedly.
Projections suggest they will likely need another $1.5 billion equity raise before 2027 just to reach a stable production timeline.
Yeah, they're going to have to keep subdividing that estate.
Which naturally forces us into the overarching debate dividing the financial sector right now. Is Joby a classic value trap? Or is it the steal of the decade?
And the analysts are entirely divided on this, entirely deadlocked.
It's wild. If you look at the consensus from 9 to 11 major Wall Street analysts, the official rating is a pure hold.
Yep.
You have exactly 3 analysts screaming buy and exactly 3 analysts screaming sell.
It doesn't get more split than that.
And their price targets are just as polarized.
Yeah.
Deutsche Bank has slapped a target all the way down at $6.
Suggesting severe downside.
Right. While Needham has a target way up at $18, implying the stock could more than double.
And that valuation clash gets even more violent when you look at algorithmic financial models.
Oh, like alpha spread.
Exactly. Alpha spread, which relies heavily on current cash flow and historical data, calculates the intrinsic value of Joby at a measly $1.61.
Oh my gosh. $1.61.
Yeah. According to their math, the stock is 82% overvalued today.
But then Simply Wilson looks at it differently, right?
Right. They look at projected future growth, and they claim the fair value is actually $12.14, giving it a 25% upside.
Why do these advanced financial models completely break down when looking at a company like this? I mean, how can an algorithm be off by nearly 1,000%?
Because traditional financial models are built to measure existing businesses.
Okay.
A discounted cash flow model works perfectly for, say, a shoe company, right? Because you can track how many shoes they sold last year and project how many they'll sell next year.
But Joby doesn't sell shoes.
Joby has zero commercial passenger revenue. They are trying to create an entirely new industry. You aren't valuing a business, you're assigning a mathematical probability to whether or not they will hold a future monopoly on urban air transit.
Okay, let's lay out the case for that future monopoly then. Let's look at the bull case. The absolute best case recovery scenario for Joby.
Let's do it.
Beyond that $2.6 billion cash runway, their most powerful weapon really seems to be their strategic partnerships. We are talking about massive, undeniable alliances here.
Huge players.
Toyota isn't just an investor. They're physically helping Joby design their manufacturing systems.
Right.
Delta Airlines has invested to integrate Joby into their airport networks. They have Uber, and they recently signed an AI deal with ASI to automate flight logistics.
And honestly, the Toyota partnership cannot be overstated.
Really? Why is that the standout?
Because in the automotive world, the Toyota production system is the absolute gold standard for efficiency and quality control. By integrating Toyota's engineers into their California and Ohio facilities, Joby is mitigating the absolute hardest part of the aerospace business, which is mass production.
Right, getting the assembly line right.
Exactly. A lot of startups can build one really cool prototype. Very few can build 1,000 identical, flawless aircraft.
And they aren't just building concepts. They've already conducted successful piloted flights over the San Francisco Bay, and they're actively building actual vertiport infrastructure.
Yes, they are making tangible progress.
But the most immediate revenue catalyst in the bull case seems to be their international expansion, specifically in Dubai and the broader United Arab Emirates. Why is Dubai so critical for them?
Dubai offers 2 massive advantages for Joby: wealth and regulatory agility.
Yeah.
Joby has a target to start early operations there in 2025 or 2026. The UAE has the infrastructure capital to build vertiports quickly, and they have a concentrated population of high-net-worth individuals who are more than willing to pay a premium to bypass urban traffic.
That makes total sense.
But more importantly, operating in Dubai allows Joby to generate actual passenger revenue and log thousands of commercial flight hours while they wait out the regulatory bureaucracy in the United States.
Which perfectly transitions us to the bear case. The absolute worst case continuation lower.
Yeah, the dark cloud over the stock.
Because all of the Toyota manufacturing expertise, the Dubai contracts, and the $2.6 billion in cash mean absolutely nothing if they hit the ultimate roadblock.
Right.
Joby's not just a hardware manufacturer, it is a binary regulatory bet.
The Federal Aviation Administration. The FAA certification is the single point of failure for the entire enterprise.
Walk us through what that actually means. Because I think people assume it's just a matter of proving the aircraft doesn't crash.
Oh, if only it were that simple.
Right. But the FAA certification for an eVTOL has to be infinitely more complicated than, say, certifying a new Boeing wing shape.
It is exponentially more complicated. The FAA isn't just certifying an aircraft. They are writing the rule book for a technology that basically didn't exist a decade ago. Think about the specific physical challenges. Joby's aircraft runs on massive lithium-ion battery packs. The FAA has to rigorously test what happens to those batteries under immense thermal stress while hovering over a densely populated city like New York or San Francisco.
Oh, the fire risk alone.
Exactly. They have to certify entirely new power-to-weight ratios, emergency auto-rotation procedures, noise thresholds, all of it.
Right.
And even if the aircraft itself is deemed completely safe, the FAA then has to figure out how to safely integrate fleets of low-flying vertical taxis into existing, incredibly crowded urban air traffic control systems.
So if the FAA decides, hey, we need 3 more years of data on battery degradation before we allow commercial passengers, Joby's entire timeline is destroyed.
Exactly. If the FAA says no, or honestly even just says not yet, it's game over for the current valuation.
Because the cash keeps burning.
Yes, you can have the best aircraft in the world, but if it is not legally allowed to fly paying passengers in American airspace, it's just a very expensive museum piece. The bear case hinges entirely on these regulatory delays. Because as we established, Joby is burning $700 million a year. They do not have the luxury of waiting 5 years for the government to make up its mind.
So bringing all of this high-level analysis, the cash burn, the dilution, the FAA hurdles, and the Dubai expansion down to the immediate timeline for you listening, where does this leave us heading into the May 5th earnings call?
Well, the short-term perspective is highly bearish and extremely volatile.
Okay.
The technicals we discussed at the top of the deep dive are pointing downward. If the stock breaks that $8.31 support, and especially if it falls below the $8 psychological level in the days surrounding the earnings call, it could easily capitulate and test that 52-week low of $6.03.
What's the market going to be looking for specifically on that call?
The market is going to be hyper-focused on any update regarding their cash burn rate and the specific timeline for that next $1.5 billion capital raise. Any hint of further immediate dilution will punish the stock price.
And what about the long-term perspective for someone willing to hold through the volatility?
The long-term outlook is intensely mixed and entirely dependent on execution.
Right.
Joby is targeting 2027 to truly ramp up production. They're aiming for 24 aircraft per year in California and 4 per year in Ohio.
Right.
But that assumes smooth FAA certification. If they hit regulatory speed bumps, some of the more conservative financial models project the stock languishing around an average price of $6.07 by the end of 2026.
It really is the ultimate high-stakes waiting game.
It is.
So, to quickly summarize what we've unpacked today, we are looking at a company with a brilliant concept, incredible partners like Toyota and Delta, and a massive $2.6 billion war chest.
Yep.
But they are fighting a brutal, near billion-dollar annual burn rate, massive share dilution that is actively shrinking retail portfolios, and an unforgiving technical chart.
It is a profound test of investor patience.
It really is. So before we wrap up, I need to remind everyone that this deep dive is strictly for educational purposes. We're looking at the data, the charts, and the mechanisms of the market to foster a natural human debate. But this is absolutely no financial advice.
No. You have to do your own research.
And if you want more of these deep dives, make sure to like the video, subscribe to our YouTube channel, and it is compulsory that you leave your feedback in the comments below. We want to know if you think Joby is a revolutionary buy or a catastrophic value trap.
And I will leave you with this final thought to consider on your own. We spent a lot of time discussing that massive gas tank, that $2.6 billion cash runway.
Right.
But think about the harsh reality of the regulatory bottleneck we just explored. If the FAA decides to delay commercial certification by just one single year, will that $2.6 billion war chest be enough to keep the lights on and the engineers paid? Or will today's retail buyers be left holding an empty portfolio while the company is forced to aggressively dilute shares all over again just to survive the wait?
Keep a very close eye on that May 5th earnings call.